Hello, friends. Welcome to American Academy for Financial Management. I'm Kareem Lakhani, and today I'm back to answer one more question. So, here it is. Besides interest rates, what other unconventional monetary policy tools can central bank employ during extraordinary economic conditions? So, as we all know, that central bank, that is RBI, is responsible to maintain the liquidity, money supply, and the inflations in the country. Interest rates are one of the major tools which they use to control the money supply and inflation. So, as the inflation rate goes up, means there's a lot of liquidity available in the market, there's a lot of money supply, and that would be because the interest rates are low. So when interest rates are low, there's a lot of purchasing power which increases, and RBI will slowly increase the interest rates so that the money becomes expensive. It will discourage people borrowing money and spending money, and because of these things, the overall inflations are going to come down. So this is one of the very important tool that RBI uses to control the economy, to control the inflation. But other than the interest rates, there are few more tools that the RBI may use during extraordinary economic conditions. So let's see what are they. So the first one is changing the CRR. CRR means cash reserve ratio. In cash reserve ratio, this is the ratio where the RBI makes the banks to deposit certain percentage of their total cash or total deposits with them with RBI as a reserve. So when RBI feels that there's very high liquidity in the market, what they would do in order to control or reduce the liquidity in the market, they would increase the CRR rate. So when CRR rate increases, banks will have to deposit a little more amount with the RBI. This will reduce the liquidity in the hands of the bank. And when the liquidity is less, they will be in a position to lend less money to the people, and less money will be available for the borrowing. So overall, because of the CRR rate, the overall liquidity is going to reduce and it is going to control the inflations. At the same time, the second tool is changing the SLR. SLR is statutory liquidity ratio. This is the ratio. It is the percentage of the cash that the bank needs to maintain with themselves. Because if they are receiving some deposits from the public, they are not supposed to lend everything that they have received as a deposit. They will also have to maintain certain liquidity at their own level, so that whenever people come to ask for their deposits back, they'll be in a position to give it back. So when the inflations are high, liquidity is high, so the SLR rates will be increased. So RBI will increase the SLR rates, which will make the bank keep more cash with them rather than lending the money to the public. And this is again going to reduce the money available for the banks to lend. So again, this is going to control the money supply in the market. The third one is issuing the bonds. So when government sees that there is so much of liquidity in the market, so much of investable surplus, and people are simply spending money, so government is going to come and issue new bonds so that people will invest into the government bonds. With this, government is sucking the extra liquidity from the market. So when people invest into the government bonds, the liquidity in the market will come down. The access to the money is going to come down. And this is again going to control the inflations and the money supply in the market. So these are the three tools which the central bank will use other than changing the interest rate interest rate in the sense of repo rates, reverse repo rates. Beyond that, these are the three tools that they will be using. Thank you.